Welcome to The Fine Print, a podcast where experts at Succession Resource Group unpack the latest industry trends, recommendations, and observations for independent advisors managing their practice with no fluff and hopefully a little entertainment. In each episode, we'll discuss ways in which you can understand and leverage the value of your business, grow your business through M&A, but also through an optimized organizational structure. Improve and protect your business to create a sustainable enterprise that can hopefully outlast you. And lastly, preparing for your eventual retirement and how to maximize that result. We're not just tackling high-level concepts, hence the title. We're getting into the details, or the fine print. So, we encourage you to listen in with whatever beverage suits your preference, and let's get to the forefront of industry trends with a fresh perspective to help you achieve your long-term business goals. Welcome back to another episode of SRG's The Fine Print. Today we are talking about private equity-backed aggregators, private equity-backed deals, dealing with private equity directly. So to PE or not to PE? That is the question for today. And joining me for this session is Kristen Grau, my lovely wife, who is also on the front lines of this topic. Since she runs and works very closely with our sellers under our seller advocacy program, she's working with sellers who have gotten these offers. Sometimes we've solicited them. Sometimes they've just shown up on people's desks, unsolicited. And so it's a topic that's coming up in more and more conversations, right? Even conversations, Kristen, you're having with sellers when they haven't been solicited by PE. You can't not open your inbox and read one of the emails from the various trade publications over the course of any given month and not see some article talking about some massive deal with crazy multiples or some crazy noteworthy statistic, which is why they write these articles. But it's happening with enough regularity and frequency now that I feel like it's coming up in just about every conversation with advisors who are selling. So out of where we want to kick it off, there is so much we can cover on this topic, pros and cons, how it impacts the industry, the advisors. I'll hand the mic over to you to start with, Kristen. Where do you want to start? Questions?
Yeah. So as you mentioned, there are PE firms in the news nearly daily, whether that's Focus Financial Partners or Mariner Wealth Advisors, Cap Trust, Beacon Point, Hightower, Carson Wealth, the list goes on, right? And I think it used to be really for really high net worth, high value firms who are getting these PE-backed offers. But as of recently, we've started to see a shift to smaller firms. So I'd love to kind of pick your brain a little bit in terms of what you're seeing in terms of who is a target market, who would be a target practice for PE-backed offers nowadays. What are you seeing?
Yeah, to your point, there's frankly two different ways we could tackle that question. You articulated probably the most common instance, right? That's PE-backed firms, right? So these are firms that have gotten good enough with mergers and acquisitions. They have somebody else's money now to gamble with. So they're really good at it, but they're PE-backed. So there, if you're a seller, you're not dealing directly with the PE firm necessarily, but you're one step removed from it. So that's probably the more common instance. And to your point, those firms have been given capital, resources, a mandate to go down market and start doing acquisitions, mergers, tuck-ins, however you want to frame it, right? They have moved downstream in a big way, and they're making offers on deals, practices now that are a couple $100 million in AUM. Now, the hard part is when you read those headlines, right? Those are oftentimes PE firms making a direct investment in a very large institution or enterprise that has sort of gotten to that size and scale, right? Where they can negotiate with and take a PE investment directly. As you deal with a PE-backed aggregator who's moving down market, right? That's different. So you're not going to be looking at the same kind of deals for better or worse. But yeah, you nailed it. I mean, they are moving downstream where the majority of the advisor market is. I mean, I've even seen them writing offers and negotiating now on deals where they've got 150, 250 million in AUM. And that just literally never happened before, right? Like you had to get to a certain size. And I feel like the B The billion was kind of that target for a while. Now it's, I don't know, I guess maybe it's still kind of a target. Like until you get to $1 billion in AUM and above, you don't generally have, it's still kind of an owner operator firm up to that point or somewhere thereabouts. And these PE backed aggregators aren't looking to buy a retiring advisor's book and take it over. They're not trying to buy your job if you're the retiring advisor. So they really want turnkey businesses. So even though they're coming down market, they still don't want to buy like the solo advisor's book, even if it's a great book of business, because when that advisor retires in 6 to 12 months, well, who's going to be left to service it? So it's an interesting conundrum as they move down market and the type of practices that they're negotiating with and looking to acquire. They really need and want that firm to continue to be run and operated by the founder and their team, and they want it to grow. And that's just a little bit out of sync with what most retiring advisors who want those PE multiples we're reading about, what they're really looking for, right? They're looking to sell and retire. And that's not always exactly congruent with those PE deals, what they're looking for.
Yeah, I think you're spot on. I talk to sellers all the time who are, just really trying to get a sense of the market. And one of the things that keeps coming up is they're having conversations with these PE firms or PE backed aggregators. And I want to, circle back around on that here in a second. But the common theme for these sellers that I'm hearing is, gosh, they want me to stay on for another 3 to 4 years to not only transition the business from, my firm, the firm that they own, the firm that they've ran for the last 30 plus years, to the new firm, right? But they also want me then to grow the business or at least sustain the business. But the growth is the key, because if they want
Right.
to get paid the cited multiple, whatever that may be, it requires some sort of growth metrics be hit in years 2, in years 3, in years 4. And it's usually above and beyond what they're currently growing the book at. So, for example, if they're growing at 5% CAGR year over year, well, then the target's going to be 6% in years 2, 3, 4 in order to get that bonus. Then the seller is contemplating, well, shoot, do I want to stay on for the next 3 to 5 years? I was kind of hoping to be on the down end slope, and instead I have to be on the up end where I'm really ramping this business up and growing it. And so it is starting to become a really unique situation where folks who are getting introductions to PE firms now are maybe like 50, 55 years old so that they can continue to grow that firm. It's really not the 60 plus. So this exit strategy is starting a lot earlier, where you could get the upside that much earlier. But because, right, in order to get to the retirement age, you've really got to grow the business. So I do want to circle back, though. You mentioned PE-backed firms and PE aggregators. For those folks who maybe don't know the difference, do you mind explaining what you mean in terms of why there's a differentiator there?
Yeah. So if you're thinking about if I'm a hypothetical seller, which to your point, we'll put a pin in that one. We could probably come back to it because you nailed it. I think we do have to sort of start redefining what a quote unquote seller is. This is not what I
Mhm.
used to think it was. It used to be pretty easy. But yeah, to come to your specific point on dealing with private equity or dealing with a private equity backed firm, you have to get to a certain size, right? And there's not like a specific number like, oh, great, you reached 2 billion in AUM. You may now be allowed to solicit offers from PE firms directly. Like that's not a thing. It'd be great if it was. Make our jobs collectively a lot easier. But if you get to a big enough size where you amass enough in total aggregate AUM, advisors, EBITDA, however you get there, you will begin to be solicited directly from private equity firms who want to make a direct investment in your firm. And we all collectively understand what private equity is in other contexts, right? They make an investment in an industry and a business, and they will pour money and resources into it to help create rapid growth, margin expansion, and then they'll flip it for an exit in a few years. So if what you need is capital for rapid expansion, then taking private equity money could be a great resource for you, right? They'll buy a stake in your firm. They'll help ramp you up. They'll help you really run it even more like a business than you're already operating as. And then there'll be an exit, which can be lucrative for everybody. But those firms getting private equity money directly, I mean, they're big, right? I mean, you're talking billions of AUM in most cases. And then you have those firms, once they've taken the private equity, they go out to market, and now their mandate is to grow, right? Well, you can't, unfortunately, just ramp up a 10, 20, 30% growth rate through purely organic sources. So how do they ramp it up? Well, they do it through recruiting, tuck-ins, mergers, acquisitions. And so those PE-backed firms are who you're more likely going to deal with, right? And that's, like you mentioned at the beginning, Kristen, it's Beacon, it's Carson, it's Rise. I mean, you can do a quick Google search, or I feel like saying even a Google search at this point is a little antiquated. You can do a Claude or ChatGPT inquiry and get a list of who these firms are, because they're generally pretty public about it. Yeah. Right? Once they've taken the money, they want to go deploy that money and put it to work. And so they want to make investments and buy firms like most of you listening. So private equity will make investments in very large enterprises. Private equity-backed aggregators will go aggregate businesses like most of you listening. So that's mostly who you're going to see and hear from is the aggregators who have taken the private equity money, sending out emails, direct mail communication, because they are really working to try to grow their enterprise, and you can be a key part of that.
Mm-hmm. Are private equity-backed deals good, bad, neither? What are you seeing?
I mean, it's a good opportunity, I think, to tie it back to that point you had made earlier on how in the heck we actually define a seller today, because how we define that seller kind of is my asterisk on that statement of, well, private equity, we've already talked about. You're seeing big multiples in the news. So it'd be hard to say anything other than private equity is good if you're a seller. But that's the rub, right? If I'm the typical seller in the industry, like most of our listings, the listings on other companies' websites, those are advisors who are at the end of their career. They don't have an internal team that's going to take over or that can afford to take over. And so they're going to list it and they're going to sell it and they're going to transition those clients over 6, 12, maybe 18 months, land the clients, and then retire. Historical retention rates are surprisingly high. And you're talking like 95% retention in most of these deals. So the advisor gets 365, they list their business, we find a handful of buyers, we negotiate offers, they pick one, we get that deal closed, they transition the clients, and then they get to retire. Unfortunately, I would say private equity-backed deals for those firms, not all it's cracked up to be, unfortunately, because if I'm selling and I want to retire, right? It's kind of why I'm selling. If I didn't want to retire, I wouldn't sell. But I do want to retire, and so I'm going to sell, and I pick Kristen to take my business over. If she writes an offer and says, well, David, I will pay you these exorbitant multiples you've seen in the market. And I say, great, I knew I liked you. You say, but to get all that value, right, to get that 10, 11, 12 times earnings figure that I promised you, I'm going to need you to stay on for 4 to 5 years. And I need you to grow it at a 10 to 20% growth rate for the next 4 to 5 years. And if you can move over, and if you can grow at that rate, and bring all your clients with you. And if the equity I pay you with in 4 to 5 years is worth what we think it's going to be worth, then if those stars all align, you can get that 10, 11, 12x figure. And the problem is, at least historically, I think we're going to do a good job collectively in the industry of starting to back that truck up and start a little earlier. But if I'm 65 and I hear you say all those words, I'm thinking, well, I'm not sure you're picking up what I'm laying down. I have been working for 30 years and I would like to now retire. I will sell you my business. You can grow it. But unfortunately, these PE-backed aggregators are trying to aggregate and then move to the next deal. They're not trying to make your problem their problem. And so this isn't a universal truth because, we've got some offers right now that we're working on where the PE-backed aggregator has been able to figure it out. But I would tell you, I know this is a long answer for a short question. More often than not, those PE-backed aggregators are looking at the typical seller who wants to sell and retire. And I've heard the term fire sale used on more than one occasion. right? Where they're viewing the fact that you want to sell the business and be gone in 6 to 12 months as like this major disruption event, and that
Right.
they'll still make an offer, right? But that's not what they're looking for. That's not a fire sale. It's just not aligned necessarily with what they're trying to do. They're trying to buy the firm, leave the management in place, you guys
Mhm.
run and grow it, and we'll move on to the next deal. We'll circle back around to you in 4 or 5 years, assuming you've been able to grow it. So if you are 65 and you like the idea of the private equity aggregator type deals and what you've been reading about, you're going to have a rough time, right? You're going to start with a full head of hair and you're going to finish looking like me. And you may have a lot of money in your pocket. You may not. One will never know. If you're 55, like Kristen said in her example, and you're thinking about maybe one of these deals, then I feel like there's a pony in the barn and you might actually have a chance to review that offer and like what it is that they're laying down, right? Because you've got 10 years, or at least 5 or 6 before you're ready to actually retire. So now you can have that monetization event.
Yeah.
And the idea of trying to grow at 10 or 20% isn't this like crazy outlandish idea, right?
Yeah. And I mean, even for the 65-year-olds, it could be a good deal potentially. I mean, time aside, right? If you're 65 and you want to sell today and you want to exit, again, like you said, there's PE firms who are still willing to do that. The rub just starts to become part of that normalization of the financials, right? When they're looking at the EBITDA figure, they're saying, okay,
Yeah.
well, if you as an owner want to leave, well, then we're going to have to add 25 to 35% and categorize it as owner compensation
Yeah.
because that's
Replacement
what
comp.
the replacement cost is going to take. And so then that just starts to gradually make your earnings less, right? Which is what you're getting that multiple off of. And so again, it could happen, it could work. It goes to these big firms, right, with great names, and so you could still potentially receive that upside. So it's not really like, is it a good deal? Is it a bad deal? It's just a deal, right? Same as it would be to a peer or to a friend or to that advisor down the road. It's just different terms. And those different
Yeah.
terms come with different risk profiles. They come with different time frames. And so it's just trying to figure out what might be best for you as part of the holistic deal. The other interesting thing as we're working with these firms, we're trying to solicit obviously the best offer that we can for a particular seller, whatever that may be. And so they want to do it based off of earnings, right? And usually that's normalized earnings, like I mentioned, right? Adjusting what that might look like. But then recently we came across where, as we're negotiating and we're doing it based on earnings, they started bringing up recurring revenue and recurring revenue trends and recurring revenue versus transactional revenue and what that might mean. Do you mind, Dave, talking a little bit about maybe the nuances there and why we find that to be a little bit interesting?
Yeah. I mean, it's kind of a funny pivot, especially when these firms start moving down market. Because if you're at 1 million a year in fees, for example, 100 million in AUM, there's a lot of those practices out there. You run a very good lifestyle practice. They being the bigger buyers, just generically, certainly private equity backed firms included in this group, but the bigger buyers price things based on the earnings because they're going to leave everything generally intact, right? They're not trying to take over your job, integrate your clients into their systems. Like that's not their MO. So they're going to leave everything intact, which means they care about your expenses. And when you look at the smaller practices, it starts to get a little more interesting, right? If I've got, just to keep the math simple, right, $1 million in annual fees, I'm looking at that and saying, well, I spend 200,000 in total expenses. So if I'm hearing a 10 times multiple as a simple example, and it can be a little higher sometimes, but it's my example. So it's 1 million and it's a 10x multiple, makes my math easy. So I got 1 million in fees. I spend 200,000 on operating overhead, and I got 800,000 in earnings. Times 10 is $8 million. Like, if I could get $8 million for my $1 million RIA, I would do that deal every day of the week and twice on Sunday, and I would do it right now. The rub is, to your point, Kristen, number one, they're going to start to do a little bit of normalization. So they're going to bake in reasonable compensation for you. So now your 200 in expenses is more like 450 or 500,000. It's
Mhm.
my example. So I'm going to go 500, keep my math round. They're going to bake in more sustainable, investment management, money management, financial
Software.
planning software, right? Like they want you on a more normal and a little bit more robust tech stack. So now your 500 in expenses looks like 600. But I mean, in their defense, yes, they're normalizing down, but they're normalizing to a sustainable enterprise. Like I get why they're doing it. It just sucks to watch the math. So it goes from your 800,000 in profits down to 400,000 in profits, down to like 300,000 in profits. And okay, but they're paying 10x, but 10x 300,000 is $3 million. The going revenue multiple is 3 times for a small RIA, which is 3 times 1 million, which is also 3 million. So in general, it's not as if the private equity backed deals or bigger buyers focused on earnings necessarily are getting to higher values. They get to high multiples, but a high multiple on a low number may be the same. It could be a little higher, it could be a little lower than the normal situation. But the example you were talking about, Kristen, goes to the fact that these PE firms are focused very much on earnings, and
Mhm.
rightly so. And so we start looking at projected earnings, the current earnings, and all of a sudden they'll come back to it and say, okay, well, so it looks like we've got about 7-8% growth, pretty consistent earnings at $2 or $3 million a year. But we start to look at it and see that there's a little bit of transactional revenue here, a little bit of financial planning revenue. That's not as good as the recurring revenue. It's an interesting juxtaposition because for the last 20 years, most buyers have focused on recurring versus non-recurring. And then maybe we start to slice and dice the recurring just to make sure we really understand it. And we obviously will pay more for recurring than we do non-recurring. But if we're going to shift gears and we're going to focus on earnings and profits, then I don't give a shit about the recurring and the non-recurring. I care about the earnings. And if your earnings last year were $1 million and your earnings this year 1.2, right? If I can see the general trend and it's growing by 10, 20% every single year, you can label the sources at the top of the P&L as recurring or non-recurring. But all I see is consistent year-over-year growth. And that's the focus when we're talking about
Mhm.
earnings or earnings-based valuations. So it's a little tricky, right, to sort of talk out of both sides of our mouth and say, well, I see you have consistent, predictable earnings, but we don't really like the non-recurring component. That doesn't matter, right? We can either focus on revenue or we can focus on earnings. We can't sort of have the best of both worlds. The buyers oftentimes are going to lean into that, so just be ready.
Yeah. And then goes the same for valuations too, right? Like I know sometimes people are like, oh gosh, if you do a revenue based valuation, those are not good. Or it's not as thorough. There's a time and a place, or there's a right answer for evaluation approach or a wrong answer for evaluation approach, depending on what your needs are, what you're trying to accomplish, what the size of your firm is, so on and so forth. And so again, this goes into so many different areas as you're looking at it. You know, an earnings-based approach, an income-based approach is really great, but we're focused on earnings, right? Which means top line revenue doesn't matter the sources per se, as long as it's
Right.
consistent and part of the ordinary business activity. And then expenses, again, more of the same, right? Are these consistent? Are they predictable? Are they normal? And then what is the earnings? But you don't look at both, right? You don't look at earnings and then be like, ooh, well, I don't really love that number. So let's dissect a little bit more of how you're coming to equate to the revenue figures. Are those recurring revenue
Right.
figures? Are they transactional or non-revenue or non-recurring revenue figures? It's like, no, no, that doesn't matter anymore. You've gone the earnings route, right? So you can't have
Right.
your cake and eat it too. You have to kind of choose one segment. And
Yeah.
then
And if you're more transactional, right, you're going to see probably more inconsistent earnings figures. So it's going to show up and generally be manifested if it really is unpredictable.
right, and you're gonna see, huge highs, low
Right.
lows, right? You're not gonna have as consistent revenue. If you're seeing, to your point, maybe 5 million and then 6 million and then 10 million. Okay, well, now you can start to get that consistent revenue growth rate, but the mix doesn't really matter anymore. So yeah, I just found that to be a very interesting spin recently in terms of how buyers were starting to equate as we were pushing back on certain earnings figures. And then it's like, well, they don't want to get that high because it doesn't cash flow right for them, right? It doesn't give
Yeah.
them the return that they're looking for. So instead, they start to kind of go back to the difference between recurring revenue and non-recurring. And it's like, well, no, we're not
Yeah.
talking about that anymore, right?
But it is a
And
good
it
point to bring up, right, on the
is,
topic. So when you think about those P&Ls, I want to get off that topic because you're right. I think about the things we used to talk about and still do to some degree on what drives the value. And I
mhm,
feel like that P&L that we were just talking about is such a simple example of a way to maybe improve value, certainly improve your experience in the process and streamline due diligence and probably drive value just by more actively managing your P&L. Because I feel like at this point, obviously the PE-backed aggregators, the larger buyers, but buyers in general are just starting to get a little bit more sophisticated, like in their understanding and expectations when they go look at your P&L. Like, again, you show up to the party now and you say, hey, I've got $1 million simple fee only RIA, and I only have 200,000 in expenses. You're saying it like a positive. They're here. They're starting to sharpen their pencils and roll their sleeves up, right? Because they know P&Ls. They know what the financials should look like. They know what they're going to have to look like inside of their systems.
yep,
And so it's worth starting to focus more time and effort and not the year that you decide to call us and start to
yeah.
help sell the business, right? Like in the 3 to 5 years leading up to that is we want those financials to really start to be optimized, reviewed on a regular basis, know what's in there, right? If we got owners, automobiles and stuff, unless you're legitimately no, period. Just get it off the P&L, right? Like anything that's borderline owner discretionary, get it out there, make your business look as efficient and stable and profitable as it actually probably is. But I feel like
Well, not
most
even
P&Ls
just
that
like,
we look at, yeah, it takes a little bit of work.
and it's not even just about the P&L, right? The profits and the
Right.
expenses. It's about just knowing your numbers all in, honestly, and getting the reporting that backs that up. Again, another
Yeah.
example, right, is anytime you're getting a sophisticated buyer, whether that's a PE backed firm or otherwise, they want to look at the data, right? They want to understand the support that makes up the numbers. And
Right.
if they have this report over here that says 6 million, and then this report over here that says 6.2 million, they're going to be like, why is there a difference? Right? Even if it's a $200,000 difference in a larger number, there shouldn't be a difference, right? And then they want to not only know it on a high level, but they want to look at it on a client by client basis. And so again, another area or room for error where that number could now be 5.8. And so it's really important to know your numbers, know exactly where they're coming from, know how many households you
Yeah.
have, know where that revenue is coming from, know what that revenue is, each quarter, each month, right now, but also make sure that when you're producing these reports, that you're producing them based on the same time frame and that they're consistent regardless of what report you're looking at. If you start to wiggle a little bit on your numbers or use rounded figures, experienced buyers are going to throw the red flag and be like, okay, this person does not know their numbers. We're going to make it even that much more confusing so that it's profitable for us as the buyer. Because why wouldn't you? It's the same thing that you do when you buy a house, right? It's like, oh, that roof hasn't been replaced in the last 5 to 10 years, and we see hail damage or wind damage. Well, guess what you're going to do, right? You're going to pick at that and you're going to ask for a concession or a price reduction or something, right?
Right.
Or a repair to get that fixed. You're not going to just let it sit. PE backed buyers or experienced buyers, they're going to do the same thing with your financials if you don't know the numbers and or they're messy. They're not going to take the higher figure. They're going to take the lower figure in my example.
Yeah. And again, they're not doing it, to your point, being nefarious
Malicious. Yeah.
or pushy, right? Like, but they're good at their job, right? Like, again, in my example, where they're a PE backed aggregator, they literally have taken investment from somebody else who's given them their money to go gamble with, right? To go try and put to
Right.
work and grow it. And so, you know, again, I think about, for those of you listening that are, what we label a potential seller, which now means somewhere between the ages like 50 and 70, right? But if you consider
Yeah.
yourself like a hypothetical seller that might read one of these emails that comes through from one of these potential buyers unsolicited, you got to know your numbers. To your point, Kristen, you've got to have your stuff in order. And I get it, right? A random unsolicited offer. You're not sitting around keeping a due diligence file prepared for 20 years. But no, at this point, like, that's not the craziest thing that could happen to you, is that you get an unsolicited offer that's worth looking at and entertaining.
Yep.
But in general, A, do put in the time and effort to at least spend time once a quarter just to maintain and monitor your profit and loss statement, look at your balance sheet, know your financials, like, know your numbers, right? Because we definitely have had sellers we've worked with, right? Where they start to get maybe a little annoyed, right? Irritated. Just, you're opening the kimono when this stuff happens, and they're going to ask questions, and they're going to ask for the same thing three different ways because they want to verify. And the worst thing you can do beyond just having bad data is being annoyed by them asking for the data from somebody who's going to be offering you 10, 12, 13 times as a
Yeah.
multiple. That's the next 10, 12, 13 times your current income. I mean, that's a high multiple. They're within their rights to start asking these kinds of questions. But I get it. Like, I remember it was years ago for us, right? When we once had a unsolicited offer to make an investment in SRG. And it was a mad scramble to pull due diligence materials together that I'd be okay showing anybody. You're just generally not ready for that stuff. But again, legitimately, if you're in that demographic, 50 to 70, and you don't plan on selling your business to your internal team, or you're unsure, then it's worth starting to just at least know your numbers, because I guarantee you it's going to come up. And it's such a nice thing to sort of control that narrative as a
Hmm.
potential seller. So, number one, get your financials in order. Number two, don't be afraid to shop that offer, right? Like, they are going to do everything in their power because these are really smart buyers. They do this literally for a living. You will do it maybe twice, right? You may sell the first tranche and then you'll sell the balance, but you're never going to do this enough times to get good at it. And I've said that in a room with people in it when I can see their faces, not just you listening to the podcast, where I get some skeptical looks. And it's usually from the 4 or 5 people in the room who they bought 5 or 6 practices. You are a neophyte compared to these buyers, right? Like, you know what you're doing in that context. And by most measures, you're pretty good at it. But they do 4 or 5 deals in a quarter. Like, this is all that they do. They win or they go home. So
Hmm.
you have to start sort of upping your game, right? When you're going to deal with these kinds of buyers. And you're more than capable. It just takes a little bit more time and research, and maybe having some different people in your corner. That's all.
Yeah. So we talked a little bit about, getting your financials in order in advance of getting an offer solicited, having your support documents ready to go. Again, time kills deals. I cannot stress
Yeah.
that enough. These sellers who just, are like, oh, well, I'm busy. I'm running a business. I have vacation.
Yep.
It's like, yeah, but you have this buyer who's ready and waiting, and they're not going to wait all day. If you're taking too long, guess what's happening? They have 6 other deals in the wings. And if you're taking too long, dragging your feet, they're just going to say, hey, you're not committed, and we have this better acquisition opportunity. We're moving on. The number of sellers sometimes that just think that they have all day drive me crazy, to be honest. I'm like, you just don't even know what you don't know. And you causing these delays is not to your advantage. But what are other things, Dave, that you get that can help firms set themselves up for success, be ready to explore offers from PE-backed firms or experienced buyers?
Yeah. I mean, you touched on it already, right? And obviously, it can be a little bit of a pain point for you when you're trying to do your best to help them. And they are too, right? But they have life and they have trips and they have other stuff planned. So I would second what you just said. Like, as dumb as it sounds as a recommendation to drive the value of your business, you spend 20 or 30 years building this thing to whatever size it's at now. That's a major accomplishment, right? Just to have made it that far. And you will generally sell once, maybe twice, not usually more than that, unless you screwed it up the first or second time, which is definitely not the goal. So give it the time that it deserves, right? If you're committed to sell, whether you want to stay on because you're 51 years old, I just had one of those conversations, or you're 65 and you're ready to retire, you spend 20 or 30 years getting to this point. When you're ready to seriously start entertaining these offers, whether it's an unsolicited offer or not, one of the easiest recommendations I can give you, it's going to be kind of annoying, but it's not a lot of work. Cancel whatever trips you have. Don't be out of town. If you're going to do it this year, for example, right? Spend the rest of 2026 and the beginning part of 2027 committed to this. Because I promise when you're done, if you're retiring, you're going to have plenty of free time to go make up for the trips that you had to cancel this year. If you're staying on and working this thing, you're doing it because you want to get the highest value for your life's work, right? There will be time for trips. And there'll probably be more time, right? Once you can offload some of these duties that you don't love doing anyway. Like, time kills deals. And I know every single time we say that, you think, well, what could go wrong? We were going to be done in another month or two. A lot could go wrong. New
Yeah.
opportunity could present itself. A spouse could become ill. The markets could drop. Interest rate, I don't know. But there's a lot of stuff that can happen. So
I mean,
that is an important one.
I even just had a buyer today who, we are literally at offer letter stage, and he has a relative who has a health consideration. He's like, I can't now submit an offer. Offers are due
Right.
literally today. And he had one submitted, we were ready to go, and now he's pulling it. And so, stuff happens, life
Yeah.
happens, expected, unexpected. If you delay, it could cost you your transaction and then you have to start over. I know people roll their eyes every time we say it, and they think that they know best, or it's like, oh, it's just a week, it's just a day, it's just a couple of months. Those sort of things add up, and buyers see it.
Yeah. Well, and it's different, right? When you're an advisor who's 65 and you're retiring and selling to, I don't know, one of your peers, or you're negotiating with another firm that's down the street, and it's still kind of, the traditional seller's market. There's a bunch of buyers looking to acquire your practice. Yeah, then it's kind of on your terms. Like, it's still probably not going to do you any major favors, but it's not going to derail your deal because sorry for the analogy, but you're the pretty girl at the dance. And so you sort of know that, right? The problem is when you start dealing with these bigger buyers, which is not a bad thing, but you deal with the bigger buyers because you want the deal, the multiples that they're talking about. Well, you
Right.
got to take the good with the bad. And the challenge there is you're not the pretty girl at the dance anymore. You're one of 20 that they're courting, and they're very interested in you. But if there's delays, if you're not getting the information to them fast enough, right? You're taking a while to make decisions, you're looking at other offers, they're just going to move on because I hate to say it, but these are big firms and they can pay you those big multiples because you're just kind of a number to them, which isn't, you could take the good with the bad, but you do have
Mhm.
to at least weigh both sides. Another one I would say is just making sure as you listen, and I know most of you have probably heard me say this before in other forums because I say it on repeat, is just prioritizing. Do you want the best price or do you want the best terms? You're generally not going to get both of those, right? Like, one will come at the expense of the other. And when I say, best price and best price is pretty easy, right? Like, the highest number. Best terms that one's a little harder to pin down because, Kristen, your best terms could mean something totally different than my best terms because that comes down to stuff that
And
all of
they
you
often
listening
are.
are.
David could take all the risk in the world and be like, I'm good with that. And
Yeah.
and I'm like, no, I want to manage my risk as much as possible. And I can count on myself, right? If I'm in control, then I won't let myself fail. But handing those keys over to someone else, I don't know if I can trust someone else, right? to fail or not fail with my money. I'm much more risk adverse than David. So yeah, to his point, even in the same household, we might have two very different risk profiles. And so the
Right.
terms make a big difference.
Yeah. And that is it's a big difference when you consider these. So I'll say new, they're not new, right? Private equity and private equity backed aggregators have been around for years, but they're around
Yeah.
in a more significant way at this point. So it's a more real consideration because the historical deal where you sell to one of your peers who's just 2 or 3 times your size, they borrow the money from one of the industry lenders, or if they're affiliated with a broker dealer, maybe the BD lends them the money. Either way, you historically had had all of your money within 12 months, usually 70 or 80% cash up front. You had a 1 year retention period, and then you got the rest of the money, and you could ride off into the sunset and retire. Like, there wasn't a whole lot to consider there because it was pretty low risk and you got a pretty good value. Now you can sort of put your finger on the scale and say, like, well, I want more value, but that changes the terms, right? Like, you're not getting all your cash in 12 months anymore, which again, Kristen and I being good examples since we're leading the podcast today, I would look at that and say, okay, I want a higher value in exchange for more upside potential. She would look at that and say just the opposite. I'll take bird in the hand versus two in the bush. So for you listening, you've got to make sure you contemplate that, right? Because the worst thing that we could ever do for you as we help you go through and start exploring these offers, right? Let's say you get an unsolicited offer. You're smart about it, right? You're not going to be all excited and just respond to them right away. We're going to respond professionally. We're going to let them know we're definitely looking at and considering offers. So great timing. You're going to reach out to a firm like ours so we can start getting a few other offers behind the scenes just to make sure you're making fully informed decisions. The worst thing we could do for you is not know what your risk tolerance is, like the work you do with your clients. Because if Kristen keeps bringing you back offers like, hey, we got this offer at 5 million, you got this offer at 5.5 million. In reality, you're like, I don't care how much money's up front. In fact, I don't want to pay a bunch of taxes right now anyway. I'd like to maybe take a little bit of my chips off the table, but I'd like to let the rest of it ride. Like, I want to get paid with equity in the buyer's firm. Like, I'm willing to bet on this. Well, then this seller's going to be sorely disappointed when they keep getting offers that are cash deals. And inversely, right, if she keeps bringing them $10 million offers where they're getting paid in Dogecoin, they're not going to be very excited about that either. So it's a whole new dynamic nowadays, which is kind of fun, right? If you're a hypothetical seller, right, 50 to 70, which I just defined as like half the industry, you've got a lot of options to start thinking about, right? You now don't have to view selling as retirement. And in fact, if you want the types of deals we're talking about with the types of buyers we're contemplating in this podcast, you not retiring is frankly almost a requirement. So I feel like it opens up a whole new realm of possibilities and things to consider, right?
Yeah. Another thing that we had on our notes in terms of, how can firms set themselves up for success is
Mhm.
processes, preparing your processes and preparing your team. This is one where, maybe Dave and I differ a little bit. I definitely think it's good to have processes, but you, as a seller, you also need to be realistic. To say it nicely, if there's a way, sometimes sellers think their business is the most amazing thing since sliced bread. And from an outsider perspective, you're still running paper files and you don't use any sort of software. People aren't going to think that this is super stellar, right? So you might have amazing processes, but if they're all pen to paper, it's not desirable. And so really just making sure that you are with the times, I think, is important, right? So every client file should be digital. If you're building systems and processes in that are automated, that is preferred, right? If it is repeatable and it doesn't require you as the owner or founder to be present, that's amazing. These are the things that buyers want. If you have to be in every single meeting, if you have to have a manual checklist, if you have to go down the street and get your box of files, or you don't even have them for some reason, which is a whole nother discussion I've had happen, that's not great, right? And also if you're like, oh, I want someone who's going to utilize my systems and processes. If they're fantastic, then, and I mean like fantastic, fantastic, like off the charts, no one's ever heard of how you're doing things, then maybe a buyer is going to want them and will retain them as you have them in place. But the majority of buyers, right, are going to change your processes. They're going to expand on the skill set of your team. They have to if they're going to pay you a premium, right? They want you to be as efficient as possible, as streamlined as possible. Make sure everyone's on the same page as they're aggregating everyone together, right? So that if you leave, another person can easily slot in, know exactly what you're doing, why you did it, how you did it, when you did it, etc. Yes, you should prepare your processes and teams, but I think you need to be flexible or fluid, acknowledging that there may be a change. Dave, you put this on your list, so I'm assuming you have a better answer or counter to my feelings there.
It's just we all as owners have blind spots, right? We think our business is great, right? We spent a lot of time, a lot of effort. It's all relative, right? But we all think we spent a lot of time and a lot of effort getting our business to where it is. And we think we've got a better mousetrap, presumably, than somebody else, right? And you might not, right? And the problem is, like you use the example, Kristen, with our processes and how we do things and how we take care of clients and wanting to share that with the buyer, which is nice, right? But yeah, if I'm an outsider looking at that deal and I've got an advisor seller who's got 5 million in revenue, right? 5 million in fees, good firm by any measure, half a billion in AUM. And they're talking about sharing their processes and their experiences with their buyer who has 5 billion in AUM and has aggregated 10 practices like yours in the last couple of years. It's not to say that you don't legitimately maybe have a better process than they've ever encountered before, but statistically it's unlikely, right? And so it's just about going into this stuff with eyes wide open, making sure that you are flexible, that you're nimble. And frankly, probably the best thing you can do is get the business valued ahead of time. Get an outsider's perspective on your business, right? Something objective. Don't have your spouse come through and look at it because he or she knows where the bread is buttered and they'll probably do their best, right? But maybe it's your CPA, maybe it's your attorney, maybe it's the valuation process with us that you start to do every year. But know where your warts are and know where your strong points are. All of this stuff will help make you a more informed negotiator when you go to the table. Because again, it's that old poker saying, right? If you're not sure who the sucker at the table is, the problem is everybody sitting at the table thinks the other guy is the sucker. And so we got to try to figure out. And if it's you, right? And you realize, okay, at least by pure numbers, I am the smallest and least informed statistically, right? Like I'm a good negotiator. At least you'll go into it with eyes wide open. So just be prepared because the game has gotten a little bit more complicated, which is a good thing, right? Gives you a lot more options. You can start this process earlier, but you just have to start the process earlier, right? Doing your homework, understanding value, getting the P&L ready, making sure your processes, to Kristen's point, are not only in place, but they're sort of institutionalized. Like that, I promise, will be music to a buyer's ears. So it may not be like the sexiest recommendation, but it's stuff that it'll help, and it'll help a lot depending on what you end up doing for a potential buyer.
Yeah. So, let's say at this point, we should know what a PE firm is or a PE backed aggregator. We should have a good understanding in terms of how we set ourselves up for success in the event that we explore options from a PE backed or PE firm. What would be some of the upsides of PE firms as it pertains to the industry?
Yeah, and it's a good spot to probably start to bring this thing to a close is some of the ups and downsides, right, based on perspective. So you said from an industry perspective, I hear you right?
Yes. Yep.
Yeah, so from an industry perspective, you might have your thoughts on this too, but I think from an industry perspective, private equity-backed aggregators, outside investors coming into this industry, I think some of the upsides from an industry perspective are parts where we've already talked about, right? Like cleaning up your P&L, running it more like a business, documenting your processing. That's a good thing for our industry, right? There's so many lifestyle businesses, and that isn't a bad thing, right? Either run a lifestyle business that is super efficient, very lean, very mean, very profitable, very tied and dependent on the founder, or build your enterprise. I think the challenge industry wide is there's a lot of folks who had really good lifestyle practices that were so good, they inadvertently grew it into a business. They don't want to be the CEO. They don't want to be the leader. It just sort of happened to them, right? Like the phone kept ringing. So I can't keep answering the phone and rebalancing and having prospect meetings. So I have to hire somebody to answer the phones. Well, that person wants benefits. Well, doesn't it make sense that benefits for one person? So as we grow, I bring on a second person. Now I got to deal with benefits. Like they find themselves as like a part-time CEO and their allegiances are sort of split. So from an industry perspective, I think private equity is just going to help us all sort of up our game, grow up a little bit. And I mean that in a good way, right? These businesses have already sort of morphed into from practices to businesses. I think with this outside investment, whether it's successful long term for the industry or not, it's going to cause businesses to grow up into enterprises. And that's pretty cool to see because with enterprises, you start seeing training programs for up and coming interns and young recruits coming into the industry, which on the independent channel, we just haven't seen a lot of. So I think it will lead to maybe some good outcomes from an industry perspective. And obviously, it's going to raise the bar, as it already has, on values industry wide. So that's both an industry pro and probably an advisor pro.
Yeah. I was going to say, values are continue to trend up. I mean, you look at
Yeah.
our annual M&A report that we put out every year, values are up. Now, again, as we said, there's caveats to some of that in terms of how or why people are getting price tags. But at the end of the day, if you're more of a risk taker like Dave, right? Or even if you're conservative like me, a higher number could be beneficial as long as the terms are right. So that's a huge benefit that
Yeah.
I would mirror. But I think that the other benefit is that sales can start to happen earlier. As we mentioned, the age for new sellers is 50 to 70. That's 15, give or take, years earlier than what we've historically seen. And
Yeah.
so folks who have built this amazing business, they're now able to monetize that quite a bit sooner while still, working, but not necessarily being that CEO, right? Still not running things. So not only do they get to take some of the upside or take some of the chips off the table, get that front end upside. They get to decrease their workload a little bit, maybe going from 60 hours a week to 40. They get baked in PTO where they can now actually also go on vacation, which they maybe couldn't before. And they get this upside of future equity. They get to still do what they love doing, right? Being an advisor first and foremost, and have this ongoing role. And so they still continue to get a paycheck for another 15, 20 years. That's both great for the industry and for the advisors again, right? It's one of those things where it just keeps on giving. And I think a lot of advisors see quite a bit of appeal to that for sure.
I mean, what's not to like, right? It's if you are fiercely independent, right, and you don't want to go be an employee, right? 'Cause, I mean, that's kind of what's going to happen if you sell out to one of these firms and go literally take a job there. Like, yeah, you're going to spend the last decade of your career as an employee. But the flip side of that is you took your chips off the table, or at least a portion of them, at a pretty high value. And you get to keep working, and you probably got paid with equity in the firm that you're working at. So technically, you're a W 2 employee, but you definitely also have equity in a high
Yeah.
growth firm, right? So you've traded your chips for theirs, and they're hopefully on a hockey stick growth curve. So it could mean a lot of potential upside for you. It also means probably a little bit less stress in the last 5 to 10 years of your career, right? Because either less stress or less of a decline in the client experience. Because I do know we affectionately refer to many of the advisors we help sell as RIPs, right? They retired in place, where they didn't take a deal, they didn't sell, but they definitely started taking Fridays off and then Mondays off and then half days on Tuesdays. Like, you've earned it. You're 65. You don't want to keep working. You're not in growth mode anymore. The problem is then selling that business when you're working 2.5 days a week for the last couple of years, that's not optimal either. So
Right.
I think from an industry perspective, it definitely gives you as business owners, advisors, but as business owners listening today, it gives you a lot more to think about. You can decide if that's a good or bad thing.
So why wouldn't everyone sell to a PE firm, Dave? What are the pitfalls worth noting?
I mean, I know why you wouldn't sell the PE, right? You're basically, you're betting on somebody else, right? And for those of you listening that think, you know what, like I'm I'm very independent. I don't want to be a W-2 employee, even if I have equity. Like, if I wanted to go have a job at a big firm where I have equity, like I'll go back to Morgan Stanley or Wells Fargo or wherever. Like, I was there. I've already done that. So I think that's certainly one scenario. Again, the other is if you have an internal team, right? I've mentored, I've trained, I've got a good team in place. Like, private equity and those values are certainly enticing, but I think I can do just as well as selling to my internal team if I start when I'm 50. And you legitimately probably could. But there's also a lot of folks that they have the internal team, but the internal team doesn't have the appetite or desire to take the business over, or
Or
there's not
skills?
enough of an internal team. Like, timing, right? Like, there's just so many externalities that are important to consider.
Hmm.
So why wouldn't you do it again if you're a little more risk averse? Because these deals are not all cash. You do need to start earlier. I mean, I think of them more as almost recruiting deals. Yes, you're getting paid and you're selling, but you're selling, you got to stay and you got to keep working. You got to keep growing it. That's how you get paid. That looks a lot like the recruiting deals I've seen for the last 20 years. And so if you are entertaining maybe recruiting deals, then it's a great deal. If you're looking at actually selling or retiring, then there's some things that might not line up perfectly. So I think for the right candidate, these sometimes unsolicited offers are a blessing in disguise. And it's a nice little Easter egg that they found, not on Easter, and they're very happy about it. And for other folks, they look at it and they scratch their head like, why would I do this? The folks that should think twice about it are the ones who are just doing it to chase the money. And I don't mean that in a derogatory way. You have built a business. You deserve to chase to get paid. But I was on a podcast recently and it was with Mark Hurley, smart guy, been around the industry forever. And he was talking about the fact that private equity is more focused right now on deploying their capital, and there's sort of stupid money out there because the PE managers want to keep getting paid their management fees, but they got to deploy the capital. There's no stupid money out there, right? Like, these are well-trained, very sophisticated investors. If it seems like stupid money, again, you're back to the poker table, right? We're not sure who the one is. If you think that there's stupid money out there from private equity, unfortunately, it's probably you. So, and again, that's not necessarily a bad thing, right? But I would say private equity and aggregator firms, they're good at this. They take a very disciplined approach, but it can very much be a win-win as long as you know what they're looking for, you know what you're looking for, and it ends up being a square block and a square hole. Like, fantastic.
Hmm. So I've done all the things, right, to set myself up for success. I know the upsides, I know the pitfalls. I get a PE offer. I wasn't really expecting it necessarily, but I prepared for it. It's coming in, and I'm thinking, gosh, this looks pretty darn good. My timeline was still set for another 3 to 5 years. But man, this is a lot of money, right? So maybe I bump up my timeline a little bit. What do I do when I have that offer in hand?
I know what you're thinking. If you're a listener and you've ever gotten one of these, you take that letter, you get that check, you run to the bank and you cash it. No, I mean, honestly, it's flattering, right? To have spent this much time and effort to start your business with no expectation of selling and getting paid, right? I mean, let's be honest. For most of us that started these businesses, like, the idea that there was equity in your business that you could sell, like, I spent the first 10 years of my career trying to convince you as advisors that you had a wealth that could be transferred and that somebody would pay for. And now here we are talking about private equity. Well, It's very flattering to get these offers, and rightly so. And oftentimes it's bird in the hand, right? Like you don't want to screw around and mess this thing up. That's what they want. Don't fall into their trap. They're going to constantly work to create a sense of urgency. This is no different than dealing with residential or investment properties. They're going to create a sense of urgency, take a disciplined approach, call us. When we go through the listing process to get other offers, it can be public, right? We can go wide with it. I mean, it's not public, like they're going to know your name, but it'd be like an actual listing. We can go the more private route, right? We got a lot of relationships. It's nice to get 2 or 3 other offers in and just compare. If the offer you got to start with is the best, then high fives all around. I've literally never seen that happen, right? There's parts of the offer that are the best. But again, just to wrap things up and show you how complex these things can get, one of the best offers we saw recently, it was a great offer. However, to close and have the down payment, all the other cool stuff that we saw in that offer, they needed to have 90% of the seller's clients sign a new investment advisory contract to be eligible to close. If we hit 85%, you don't have to close. Yet you've now disrupted your book and had signatures from 85% of your clients. So you take the good with the bad. The deals are just more complicated. But I would say when that offer comes in, pause, take a breath, and call somebody. You get one shot at this. So let's just make sure you do it right.
Yeah, I couldn't disagree or couldn't agree more. I think, definitely pause, call us, don't just sign on the dotted line and think that it's going to be a win.
I think that's probably a great place to wrap, right? Because it's complicated. There's a lot to it. And not that you can't figure it out, but I promise if you figured it out on your own and then you did it one more time, you'd be even better at it. If you did it the 3rd time, you'd be even better at it, but you just don't get any more bites at the apple. So selfishly, yes, call us. But no matter what you do, the recommendation is just pause, call somebody, take a beat, and make sure you approach this thing in a very disciplined approach, because I promise you that is what the other side is doing. There are no emotions on the other side. So with that, that's a wrap. We hope this gives you a little bit more information on this topic, because kind of like AI, when we saw private equity come into the space, it was hard to tell if this is sort of a flash in the pan or just for the biggest firms in the industry. But I think at this point, they're here to stay for the foreseeable future, and it's a real option for a lot more firms. But you do want to make sure that as you start exploring this stuff, that you don't always have to be the smartest person at the table, but you don't want to be the opposite of that. So hopefully this helps add to your homework and get you a little more prepared. Thanks.
And that concludes another episode of The Fine Print from SRG. We hope you found this episode both interesting and valuable. We encourage you to check out our website at www.successionresource.com. And of course, connect with us on social media for the latest happenings here at SRG. If you just can't get enough of The Fine Print, we invite you to join our monthly webinar series and newsletters where we address many of the topics covered in this podcast in greater detail. Finally, if you enjoyed today's episode as much as we did recording it, please leave us a review, a good one, mind you, and tell your industry friends about us. Your support helps us continue to bring you the best content possible. The information covered and posted represents the views and opinions of the guests or individual hosts, and not necessarily the views or opinions of Succession Resource Group. Content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional advice, as amazing it might be. Always seek the advice of an expert with any questions you may have. As always, we at SRG stand ready to help when you're ready.